Right. Carry trade. Now, this is a technique which actually used by most of the hedge funds and many of the big banks and the investment companies. I don't think so anybody in this group will actually do this carry trade, but this is only just to let you understand how the Forex trading works. For example, in Australia, interest rate is currently 1.5%. In US is 0.5%. The net difference between Australian and US interest rate is 1%. For every 100,000 US dollar, you earn 1% per year. Because of the leverage, you only require $1,000. So for the $1,000 interest you pay, it's for the $1,000 interest per year on a $1,000 investment. So you can see the issue is that, for example, if you are long on Australia and New Zealand, or Australia and US dollar, it means that you are earning 1% interest rate, which is also called swap rate or overnight rate or whatever. They use a different term. So AUD, USD, one lot, you earn $1,000 interest in 1 year. But because of the leverage, you don't actually put upfront 100,000 US dollar, you only put $1,000. So you actually earning $1,000 interest on the $1,000. And that's how the big investment firms actually make a lot of money. They actually will go long on Australian US dollars for maybe 1 year, 5 months, 6 months, whatever. And then because of the leverage, they can actually earn more interest rate on that one or more income than anything else. And that's why you see that many times that Japanese interest rate used to be 0 and Australian interest rate used to be 2.5. At that time, many people actually bringing money, they were money into Australian dollar, the Japanese bringing their money into Australian dollar because they can earn higher interest rate. In Forex market, you basically simply go long or short a currency which has got high on the interest rate and you start earning that money. Okay, now it's come to the Forex fundamental analysis. So Forex fundamental analysis or Forex fundamentals to understand is very, very simple. You just follow the money. In any country, if the money is coming in, it means that that's the price of that particular currency will go up because these currencies are in demand and the supply is short or the supply is high or whatever other way around. The money will come to in any country due to the capital flow or the trade flow. The capital flow is the performance of the economy of that country. Also, the capital flow means the interest rate of that country. If a country got a higher interest rate and a country also got the good economic, the stability, then you will see the prices of that currency will go up. Another factor when the money flow happen is the trade flow. Every country buy and sell in the global market. We buy Chinese goods, Japanese goods, and we sell oil to the Japan, or we sell our natural resources to China. The difference between the import and export is called the trade deficit. If a trade deficit is higher, it means that the money from your country is flowing out. If the trade deficit is balanced, then or it's on the other way around, then it means that the money is flowing in your country because of this trade balance. An example of that one you can see when the resource market was at boom in Australia, our trade balance was positive. The money actually were coming into our country. Now that's trade boom or that's the resource boom is over, our trade balance is in negative. It means that the money is flowing out of Australia, going to China, Japan, US dollar or whatsoever. you can see that if the capital flow coming into the country and the trade flow is also positive, or the trade balance is also positive, that will create demand for that currency, and the currency prices will go up. When the currency prices will go up, it's mean that the product you used to export, they become more expensive. And then it can actually have an impact on your export and your trade balance. So these capital flow and trade balance, they are so much interlinked that you can't just rely in one or two to determine that the currency is actually going to go higher or it's going to go lower, because they are almost interlinked. So another example, let's say you got a lot of capital flow coming into your, I'll give you an example of America. So America is a net importer of many goods and the petals and everything. It means that the trade balance is always negative. Money is going out from America to the Japan or other countries. But American system and American political stability is so much stable that people try to invest their funds or their money into American economy, American stock market, American housing market, or American industries. It means that they need American dollars to invest in America, and the capital flow is coming into the country. So that capital flow is actually balanced out the trade deficit. And that's why US dollar will go up. But then you will see that if the US dollar is going up, it means that the trade balance will start blowing out, and it's going more negative and negative. And if for whatever reason the current country's economy is stalled or goes something wrong, then it means that people start pulling the money out from that country and the dollar will start falling. Now, right now in this situation, currently what's happening, this dollar is going up and up and up against euro and every single currency. And the main reason for this one, because the President-elect Trump have promised to invest a very, very large amount of the money into the infrastructure, creating local jobs and expanding the local economy. That's all positive signs for the capital flow. Maybe they're not positive sign for the trade balance, but it's all positive for the capital flow. So it means that people who are looking to invest in America, they are demanding American dollars and the prices is going up. Now, another impact of this all capital flow coming into America will happen soon is that interest rate will go higher because of the inflation. If interest rates goes higher, that means that that particular currency will attract again more capital flow, and then that cycle actually goes on. At the time when it's reached the peak, it will start reversing. So always remember, if you want to see a country's economic situation, just check the capital flow and the trade balance of that country and the interest rate, and you will understand whether you should invest in that particular currency or not. There are key economic indicators which is coming into the next slide, which help you to understand the capital flow and the trade flow and the interest rate of a particular country or particular currency. You also need to understand the political situation of a country. If the political situation is not stable, then maybe this particular currency will not benefit from the capital flow, trade flow, and the higher interest rate. As you can see here, these are the key things what you need to understand why money actually got a flow. These are as we mentioned, that's the capital flow. So these are the key things which can bring currency or the capital into a country. New investment opportunities, hot stock, real estate, high yield bonds, inflation, interest rate, and political situation. And these are the trade flow, that's trade balance, industry needs, and political situation. Now, these are the key indicators. So of any country's interest rate, inflation, trade balance, GDP, credit, commodity prices, employment data, and CPI. These are the key economic indicators which will help you to understand that a particular currency having a capital flow and the trade balance or not. Out of those, interest rate and the employment data is very, very important. Especially the employment data will indicate overall condition of an economy. If the higher unemployment means that economy of that country is not performing well, lower unemployment rate means that the current country's economy is performing very well. Commodity prices also play a very big role, especially with those currencies which are commodity based, and those countries are Australia, New Zealand, and Canada. Trade balance is very important for the Japanese yen because Japan is a net exporter, and its need its currency to be in a proper shape or format to get the benefit of the exports. If the Japanese yen goes higher, the Japanese export will start dropping down and people will not buy, and then it means that Japan will actually hit with the bad economic condition where it might go into the recession or something. So the export is very, very important for Japan, and that's why you see many times Bank of Japan intervene into the yen to make sure this yen doesn't actually appreciate in a price. Okay, news and classification. So high impact news, medium impact news, low impact news. Normally, I don't recommend to trade before or right after the news item. The reason why, because the high frequency traders or those computer trading, it's actually very, very active. They can drive the prices extremely high and then extremely low, and people will actually lose money. So what is recommended is when you see a particular high impact news is coming, you let the news happen, wait for about an hour or 2 hours. Once the price is stabilized, then you enter into the market based on your analysis. But never enter in a market around the news time, just before or right after, because this time is very, very active for high frequency traders, and they will drive you out very, very easily from the market. Now, let me see if I can get if I can get into the website and see if so forexfactory.com. Right, so now you see that's all the important items are here, and you can click on this filter. These are all the currencies you want to watch for the important news item. The red means the important, this is the less important, this is the more lesser, and this is just the normal news. These are the event type: growth, inflation, employment, central bank, bonds, miscellaneous, speech, business, this one. So what I will do, I will show you something like I normally do it. So I'll click none, nothing is selected. Now, for Monday or next week, I want to monitor US dollar, Australian dollar, euro, British pound, Japanese yen. I apply my filter. And then I click on this date. I will start with the 5th of December until the 9th of December, and I apply the setting. Now, these are the news happening next week, and you can actually see that on Tuesday, 6th December. So these are the American figures are coming, and same day is Australian cash rates is coming. And if you want to see what the impact will be, you can actually see here, all the way here, and it says like the actual more than its forecast is good for the currency. These are the forecast, right? And these are what's the last time it was. So for example, the Australian cash rate, everybody is expecting nothing going to change. So it means that these forecasts is already factored into the prices. So that price will not make any difference into the Australian dollar unless the price actually or unless the Reserve Bank raise or reduce the interest rate by 0.25% or whatever, then it's not as per the market expectation, and that will actually create a volatility in Australian dollar. So this is very, very important. On every Sunday or every weekend when you log into your computer, you just do your analysis, make sure the currency pairs you are trading and you know what news items are happening at that time. Another thing which I like to tell you is that you can see I got 11, 18 a.m., 11. Here you can actually set up your timing. If you are on the different time zone, so make sure you are on the right time zone first. Otherwise, you might see this news item is from the different time zone and you can't understand the timing. So that's very important, very, very important. So I normally keep it Eastern Standard Time, daylight saving is on, and that's it. And then that's this timing which is showing here is the Australian time. So Australian time, 2:30 p.m. That's when the interest rates announced, and it's a GDP. So these are important news items for the next week. Now, the one of the very, very important news item which has happened every month, every Friday, is non-farm payroll. Non-farm payroll is actually non-farm, not farm, FARM, non-farm payroll, which is American unemployment data. And it's announced first Friday of the month, 8:30 a.m. US Standard Time or Eastern Time, which is New York time. Okay, very important for any pair with the US. Do not trade at the time or before the news. Let the market settle down. Normally, my style of the trading around the non-farm payroll is 8:30, the news announced. I wait for 9:30 or 10 o'clock, and then I will put whatever the price at that time of the market. I will put 30% of my 8-hour pip, or let's say 10 pip above, stop buy order, and 10 pip below a stop sell order. Now I'm waiting for the price to move in a one direction. So whichever direction it will go, then hit my order, I will cancel the other order and flow with that particular order. That's very, very good strategy. The only problem with this strategy is that if you don't have your assessment of like how many pip above and below you want to put, then you basically either you lose your money or you won't go anywhere at all. So important to understand that's the where you want to put your stop sell and your stop buy order. Okay, these Forex trading secrets, I will show you as we go along. So it's just put up here. One of the principle of the Forex trading, you need to understand your stop loss. Another one is you need to understand your broker. If you don't understand your broker, whether it's a dealing desk broker, will he open a position against you, or will he put your order directly into the market? That's very, very important to understand. So these are the first of the two principles of the Forex trading. Make sure your stop loss is proper and nobody can haunt your stop loss, and you don't deal with the dealing desk broker. So market psychology is basically the two things. People buy because they are greedy, people sell because they are fearful. So who and what influence the market trader psychology, you need to understand. So whatever you see in a chart, that will show you the fear and greed of the market. If people are greedy, prices will go up. And if people start selling, then it means there is a fear that the market reach its peak and now it's going to reverse, or the fear that they have actually put into the wrong side of the order and they want to get out of the order. So that's very, very important, the greed and fear. And normally the greed and fear happen most of the time with the new market player or new traders who don't understand the price action. They simply do the trading based on their gut feeling, and when they see it's not going against in favor, then they try to get out of the market, and then it's also put a role in the market pricing. So fear and greed is very, very important. You don't use your emotion when you do the trading. Your emotion, you leave it in the lock room and do your trading purely based on your rules and your price action understanding. Okay, so we have three types of the traders: buyer, seller, and undecided. The only trader who doesn't make money from those three, the one who is undecided, because he don't know if to buy or sell. The buyer or seller, they will make money, but the person who is undecided, he will never make any money, because you can't swim if you are just at the corner, be sitting at the corner of the pool. You have to go into the pool to swim. This is the price action. What's happened? So you can see that we start from here. So here is the green bar is going up, 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 up. It means that people are a little bit greedy here. They want to make money, but when they reach right up this angle, they start feeling that, oh, sorry, we come too far. Our prices shouldn't go that far. I think somebody will bring it down. So they start selling. And when they start selling, you can see they start chewing up these prices back here. And they leave a very, very long tail here, which shows that the price, at one stage, the price reached at this level, but people were not agreed. The trader didn't agree on that price. And that's why they start selling their stocks or their position and bringing down the prices back here. And the same thing you can see, the same thing you can see with this red bar. Red bar is actually people, when see that the prices move too high, they continue dropping the price all the way back up here. So if you understand again that at this stage, everybody see the price actually reach the bottom, they start buying. So the demand is increasing, so as the supply. So the people who actually hold that currency pair, they bring into the market, they start selling, people are buying, the price actually move up, 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 right up to here, and then they realize that it had actually reached quite high. And now when the price actually reached at this stage, many of the buyers who wanted to buy, they actually stop and say, oh, sorry, I can't buy that high. And now the demand actually decreasing, supply increasing, so the people actually start selling. They start selling all the way back here. Then there was another push coming to the market to drive the price up. It didn't succeed, and then ultimately the price actually come down. You can see that's the entire supply and demand in one cycle. Supply is demand increasing, supply increasing, demand actually decreasing, supply is decreasing, and people are started selling here. This is actually, you can see the people's psychology up here in this particular trend. And this happening from all the way from here. This is the 1 hour chart. So it's 1 hour, 2 hour, 3 hour, 4 hour, 5 hours. So within 5 hour price goes from here and it's come back here. The people who make money on the day trading, this is their actually timing to make the money. So they start making money from here, they sell here, and then they actually, they close their position here, and then they enter short, and then they close position here. So here you got basically two opportunities to make the money, one on the upside, one on the downside. If this is Euro USD, which is yes, so you are actually buying Euro all the way up here, then you sell, then you close your position, and you short on the Euro, and you close your position here. That's how this is actually work. And if you understand this market cycle, how it's operate, and where to enter and where to exit, then you are actually, you can make a lot of money. So this very, very important to understand your entry, your exit, and when to go in which direction. And this is because the trend identification. So if you identify your trend, and that's, you can help, you can actually be successful. Some amateur traders, when they enter into the market, they actually see that, oh, price is going up, and suddenly they can see that they say, oh no, I have to jump into the car. So they actually race and they buy, they put your buy order here, and then they suddenly see, oh, that's what's happening. The price is coming down, and now they start losing. The reason why, because their entry is not at the right time. The entry should be in this bar, not on that bar. So we need to understand your entry, and your timing of the entry is very, very important. If you enter at the wrong time in the market, then I can rest assure you that you will lose your money very quickly. Okay, so trader psychology is one of the important items you need to understand. That's you need to believe in yourself that you can make money from the market. If you don't have this belief, you're not gonna take any action. You're not gonna do any commitment, and you will not have any result at all. So the belief in yourself, you can do something, is very important. And if when you know that you can do something, then you have to take action. When you take the action, you have to put some commitments, time, financially, and if it's produced a positive result, that will actually feed into your belief. Your belief will become more stronger, and as your belief goes stronger and stronger, your action and your commitment will increase. At the time will come that your belief is actually kind of overconfident, and your action will act according to your overconfidence belief, and it may actually bring you down. So the belief is important, but overconfidence, yes, it's a little bit, you have to worry, you have to careful. So at a right belief, right action is important. Over belief or over commit or overconfidence, it can bring you down. Okay, this is the question that if you have a negative thoughts about the money, then you will never achieve your goals. You need to think that money is not your evil. The money is not your enemy. Money is your friend. Money can actually help you to do so many things, and money can actually bring the change in the world. So you need to actually understand what your thoughts are about the money. Many people actually believe in saving and says the money will actually come and help me when I will save a lot of money, but the many people actually think if I save my money in my bank, the money is doing nothing, it's idle. I want this money to work harder for me, and I want to make some profit from that money. So these are two different thoughts. The people who actually think that they want their money to work for them, they will do the investment, they will do the trading, they will do lots of other activities and make sure their money actually work for them. The people who actually don't believe in that the money can never work for them, they will let their money sit in the bank and it will not grow or it won't actually increase at all. So you need to understand that your belief about the money is very important in your goal achievement. If you believe that you need your money, if you believe that money should work for you, then yes, you can achieve your goal. Now it's come to the technical analysis. I will actually just say that anybody want to ask any questions about whatever we have learned so far. What is the time difference between measurement of the interval? What do you mean? I don't understand your question. This is from Mustang, sir. Right. The chart that you showed. Okay, we will come to that one. When we come to the timing, we will show that. The price goes okay. Okay, it's very difficult view. Okay, just go to, okay, I'll put it up here. Okay, okay, and I will go to my chart screen. Yes, I can. Okay, here you go. Now, whoever is asking this question, he can, if you want, you can ask the question, unmute his mic, and I ask the question straight away, but just one at a time. So. All right, so if no more question, then I can go to the technical analysis. Technical analysis is basically, we're going to learn on this one is chart basics, candlestick formation, buying and selling pressure. reversal bars, and those what item you can see up there, and plus some more. Maybe we will not cover every single technical analysis here. I will cover part of this technical analysis, like for example, chart basics, candlesticks, and reversal bars and candle. I will leave other things like the price action for tomorrow. And after that, I will go into the money management so we can understand the stop loss and those properly. Yeah, so this is all again, the price action, understanding charts and those. So the technical analysis is about the assessment of the price movement. The price movement which already happened. There is a theory from Charles Daw that's the price what you see on the screen is discount everything. It means that the news items, any events happen at the global level, the volatility, whatever, it's actually already discounted in a price what you can see on the chart, because otherwise you can't see in the chart. So this is what you are looking right now. It's at that time included all the events in the markets and their impacts. So as it says here, price discounts everything. Price movement are not random. When I say the price movement are not random, what does it mean? That if you look at the history of the past 10 year, 20 year, 50 year, even 100 year, when they start using the technical analysis, you will notice that the prices movement are actually a repeatable history. People remember their history, their memory are very strong, and at certain level, the price actually doesn't move at all. It's actually going to the same direction. And see if I can actually show you something here to understand that part. It's actually very helpful. Where is it? Right. So this is what I got here. Everybody can see the screen? Okay, okay. Okay, everybody can see my screen here? This chart?
Yes, yes.
Okay, all right, that's good. Because I don't know, like, I mean, this is a Windows, another one is a Mac, so I was a little bit confused. So you can see here that this is, I got the Euro USD on daily chart time frame, right? And if I can actually read this few lines first, everyone. And this is from here is the 1st of the December. And here you can see that this particular price is actually a lowest in that last 1 week or 2 weeks. And if you actually look at the history right up here, you can see that exactly 1 year ago, the 10th of November, the price was at the same point, and then it's actually gone up. And you can see this action, what's happened here, it's happening right now here. You go back a little bit further, 13th of February, the price has actually reached that point, and then it starts shoot back, then come back, but it's never actually gone below that point. This is what we say that history actually remembered by those things. If you go a little bit more further up here, see how far I can go, and you can see this is the lowest point ever I can see that my price actually have moved. And that's I can go up to the 6 May 2012, right up to here. And look at that event. It's exactly the same point it's touching. And that's why I say that I think the people who actually have learned this technique before, they had make a lot of money on, even though the demo account, but they did some. And they actually seen that when I told them like it's touching the strong support, it means that you can see that it's just touch here, you enter your market and then you exit here. And that's what actually we say that's history actually remember. And it's very, very strong. Let's pick up another one just randomly. This is the Euro USD. I will pick up Australian dollar and Swiss franc. Right, so this is also daily chart. And I can't go any further from here, maybe. And look at here, again, the same thing's happening. So if I put my lowest price here, here, and here, okay? And now watch. You can see, this is, see, it's reflect, it's bounce, it's bouncing back, bouncing back. So when you start understanding those and identify those areas, it is a very, very strong, I mean, your skill that will help you to make the money. And this is what we will learn as we move along. Right, so, okay. So the price movement are not random. They are, remember in the history, price is set by outgoing supply and demand. We all know the supply and demand. If the supply is higher and the demand is lower, then the prices will start dropping. If the demand is higher, supply is lower, then it will start dropping. So it's, yes, okay. Right. Chart are the core of the technical analysis. You need to understand this particular chart. That chart will help you to actually make your decision. So it's a very, very important thing, the chart. It's most important. If you don't understand the chart, you can't understand the price action, you can't do the trading. So make sure you do spend some time in the chart. And you see, the chart trading is a kind of a skill. You can't actually just learn in 1 or 2 days. You have to practice that one. If you don't practice, you will forget. So you learn everything today, and then if you don't practice on the daily basis, it's not going to help you. More practice you do on the chart, it will actually your brain will tune to react to the chart pricing and those things. So, and give you an example, like if you know how to to fly a plane, but if you don't practice, then maybe one day when you go there, you sit into the cockpit, you don't know what to do with all those equipment. So you need to make sure that you at least stay in front of the chart, try to understand at least an hour a day, and that will sharpen your skill and it will tune your brain to the chart. The very, very basic principle of the making money: buy low, sell high. Where is the low and where is the high? That's the very, very important things to understand. And how to understand, that's again, technical analysis will tell you where is the low and where is the high, so you can sell at the high and you can buy at low. This is a chart and the price action, the different part of the chart. And as you can see here, these the green and the red bars, this is the seller bar, this we call buyer bar. It means that the price is close above its open, and the seller bar implies is actually close below where it's open. This is the high of the day or high of the bar. This is low of the bar. We'll move that one. Then you got this moving average. This is a mathematical calculation based on the certain number of the periods. For example, last 10 days, what's for the average of the price. And we put a dot here, and then the dot actually continues on every last 10 days. So one day, the next day it will drop the last one and then add another one. So when you have so many dots on your chart, and if you connect them, it will make this line, which is called a moving average. Here is your time axis. So that will tell you what's the time at that time or what's the price at that time. So it is called time axis, and that's your price axis. And this price axis and the time axis is basically 2-dimension chart. And in this 2-dimension, everything relate or the cross reference to each other, the price and the time, they are the reference for this chart. These up here, these indicators, they are all mathematical calculation and the complex calculation, different algorithm, a particular time. If the prices was moving in this direction, what's the impacts, how I want to do and what it is. So it's a complex calculation. We will learn about 4 or 5 different indicators. We don't need to learn a lot. We want to keep our chart as clean and as easy to understand possible. If you put so many indicators on your chart, it will actually make you confused, that's all. So we need to make sure we cover the thing as we only put those important information in the chart which we need. you come to this corner, that's your currency pair Euro USD. H1 is a 1 hour chart. It means that each bar represents 1 hour. And if it's a D1, that is mean each bar represents 1 day. If it's H4, then each bar represents 4 hours. So that's what you can see here. So each bar is, and the prices movement and those different indicators point at that particular time. So you don't need to much worry about this one. And now come to here, this particular red line is ask price, and there should be somewhere in the bid price. Normally you will see on your chart is a bid price. For the ask price, you need to enable a feature in your properties so you can see that's ask price, otherwise it won't be there. Okay, so what else left in this one? Okay, I think. Now, the chart data is very, very simple chart data. We got only about 5 or 6 basic elements in a chart data. We need opening price, closing price, high of the bar or high of the period, low of the period, volume. That's it, no more. So open of the price, close of the price, high of the day or high of the bar or low of the bar in the volume. These 5 things you need for the construct your chart. The volume is important in the stock market. The volume is not very important in the Forex market. The reason why, because it's the Forex is very, very highly liquid market. And another reason is Forex doesn't have any central exchange. Every broker and every bank, when you try to bring their data together, it would be too late for the market. So how do we determine when is a high volume or the low volume for the Forex? It is the time of the day you trade or time of the day you are trading. When you see that's your bar, when you see that you are trading between London time or London trading zone or American trading zone, these time you will see the volume is the highest. So that's the only way you can actually determine when the volume is high and when the liquidity is high in a market. Australian time, the Asian market, which is the Japanese market, normally have very low volume. So that's another reason why I recommend that when you want to start your trading, you trade during the London market and the American market. And somehow we are fortunate that when we come back from the work, 5 or 6 o'clock, the London market is about to open or is already open, and we can trade from our home and we can do whatever we want to do. We don't actually have to leave the job or try to trade during the job. So the timing are very, very perfect for the Australian traders. So after 6 o'clock, they can sit in front of the computer and then they can do a little bit trading, and that's actually can help. So there are 3 type of chart: line chart, bar chart, and the candlestick charts. In the next few slides, we will highlight all those charts and see which one is suit best to us. So these are the 3 different type of the chart. Line chart, which is this one, it's only draw this line based on the closing price. So you don't see any day of the any high or low or close or open during that time. So this is the line chart. The bar chart and the candlestick chart, they use these 4 price points: open, low, high, and low. The only difference between the 2 is the presentation of those pricing is the only difference. So you can see this is the bar chart. You got this big line. This is the open, close, high of the day, low of the day. Same thing here. Open, close, high of the day, low of the day. And now it's come to the candlestick charts. So let's say, for example, this is the one. So open, close, high of the day, low of the day. So the only difference is the representation of them. It's up to the individual choice, like which one they can see more visually attractive to them, or which are visually easy to understand. I found that the candlestick charts, they are easier to understand because their visual presentation is a little bit better than the bar chart. The candlestick charts invented in Japan in about 300-400 years ago when they were doing a trade for the rice. And when they were doing trade for the rice, they actually used to plot those opening price of the rice contract, closing price of the rice contract, high and low, and then so it's come back from this history from the Asian. The the bar chart is American and the European invention, almost the same 4 price point, but it's just a different representation. So as I mentioned, there are 4 important points we got for the price: open, close, high, and low. And this is how you can see in a bar chart: open, close, high, low. When the price is closing above opening, it means the price is going up. When the price is actually closing below opening, it means the price is going down. High and low on the both cases, they are the same look points. Now you can see here this bar chart, an example, and you can see this green bar here. So it's open, close, high, low. This red bar, open, close, high, low. Now, the candlestick is got, when it's a high price, then it's called high wick. When there is a long wick down, the downside, it's called the down wick. I can give you some example of this one. So for example, let's say this is your price axis and this is your time axis here. Your price open here, it's moved as high as here. Then the prices come down. Then it will start moving up and close here. So this is the movement of a day in a price. So if it start here, it goes as much high as here, it goes as low as here, then it's close here. So you can see that's open, close, and this body. So this is the body which actually represents the actual price movement between open and the close. The bigger the body, the bigger the buyer pressure is in the market. Now that's your lowest of the day. That's your highest of the day. What does it mean that it's at certain time actually price actually moved to this high, then market didn't agree on that price and they start bringing down the price. So they start selling their order at this state and it's coming down right up here and then the close here. So this 4 part we need to understand. This is your high wick, this is your low wick, and this is your bar. I can't hear you properly, Asif. Is everybody else hearing properly?
Volume is bit down. Everything is fine, but volume is bit down, so that's why I can't hear you. I can't wear the headphone.
Okay. Is anybody else having the same issue?
That's why I thought maybe it's from.
Okay. All right, I will try to speak a little bit higher. We can hear well. Okay, fine.
Thank you very much. Thank you.
That's fine. Right. So, as we was telling that this important part of this particular bar you need to understand before you move, and one of them is can we get this bit of presentation? Yes. Okay, I will put this presentation to the people after this, after I finish that. So you need to understand this particular bar. You need to understand this one. If you understand this high, low, and this body, their shape and their size, half of your trading is almost done. So on this particular scene, you can see this, the longer the wick on the buy bar, the longer the wick on the upper side, it means that the price is actually about to reverse, or is indication that the price actually reach at his peak point and may not go any further. Same thing happened at the lower side, but the important issue is the location and the context of this particular bar. If this bar, you can see with the green candle, higher wick, long high wick at the top of the price range, then yes, the price will reverse. But if the same candle with the high wick, it appears in the lower side of the bar, lower side of the price, then it's have no significance. So this is the same for the seller price, and you can see there's a price actually open here and closed lower. So that's why it's called a seller bar. So this is the buyer bar, this is the seller bar, this is the high wick, low wick, is always the same. Now I'm going to show you some, again, the little bit differences of these, the three different charts. One is a line chart. They all same price, same time, everything is the same. And you can see like which one you feel you can understand, and visually you can understand better. So this is a line chart, right? This is the line only closing price. This is the same chart, exactly the same time frame, same data, everything, but this is a bar chart. And this one is your candlestick chart. So you can see these three bars, they exactly the same thing, nothing different, just a different type of the chart, and they represent you differently. So again, line, bar, and the candle. It's up to you guys which one you want to use, which one you feel comfortable with. The line chart, so not the line chart, I don't think anybody will use, but the bar chart or the candlestick chart. I use myself candlestick chart because I can see those high wicks and low wicks much better on the candlestick chart rather than and easily recognize them rather than the bar chart. So an example, this is a candlestick chart. You can see this particular body here is a high wick up here and is a low, very small low wicks, and this is the price body. If you look at the same thing here, this is the one. Which one easily recognizable or visually you can see? It's this one or it's this one. So it's personal choice. Now we're going into the detail of those candlestick, and what we can do, we can actually, what time you guys want to go for lunch? It's 12 o'clock. Any preference?
In the morning, so I can't do lunch at the moment.
No, it's not for you, it's for the people here. 1 p.m. Is everybody agreed on 1 p.m.? Tim, what time you want to go for lunch? Nasir iPad is okay. 1 p.m. is fine. Okay, so we go for 1 p.m. for the lunch. So let's continue. Okay. Now we're going to start moving into a little bit more of the candlestick, the chart volume, chart pattern, and all those time frames. Now the price, let's go here. So each candle represents one period. What does it mean? That's the one period where you got the opening price, closing price, high and a low. In one candle, that's represent one period. A one period can be 1 day, 1 month, 1 week, 1 hour, 4 hour, 30 minutes, 5 minutes, and 1 minute. This is the time frame which I'm talking what's happened in the Forex. So some in stock, they also have sometimes 3 minutes and you can actually customize yourself. But here you got day, month, week, hour, 4 hour, and 30 minutes. Period range is the difference between open and the close. So that body which you see on your chart, the green body or the red body, is the difference between the open and the close. And that's your actual price range for that particular day. Length of the chart represents the volatility. So higher or bigger the length of the chart, or the length of the bar is not actually chart, is the bar, is represent the volatility of the market. If the bar is smaller, it means that the difference between closing and opening price is very, very low. What does it mean? That if the difference is very low, you can't make much money. And you only pay the commission to your broker. So it's advisable that when you see in a chart that there are so many small bodies, you just monitor for a time, because there will be a time comes when that's actually breakout either in upward or in a downward. And we will learn those techniques tomorrow, how to actually identify those upwards and downwards movements. But for right now, you need to just understand that the body size of the body is actually your volatility of the market, or the price difference between opening and closing is what you can make the money from. So we always make money from the volatility of the market. Length of the wick represent bull and bear action, buyer and seller. So longer the wick will actually tell you what kind of the pressure we got in a market. It's an upward pressure or it's a downward pressure, right? So upward pressure means that if you got a high wick at the upside, it's mean that seller are actually pushing down the prices. Buyer tried to push the prices higher, but they could not sustain the price, and the seller bring it down. The same thing happened other way around. If you got a very, very long low wick, it means that seller did try to bring the prices down, could not succeed, and buyer bring the prices up at the closing level, and you actually see that's a buying pressure. So so the size of the body of the candle is your volatility of the market. The length of the wick is the pressure from the buyer or the seller. Now, in the last sentence here, it says each candle has a full-blown story. That's very important to understand. So look at here. This is the 1 hour chart. It means that each bar represents 1 hour. In that particular hour, this is the open, close, highest of the bar period, and lowest of the hour. So that's one is a 1 hour. From right up here, this is the start of the day. So 1, 2, 3, 4, 5, 6, 7, right up to here, it's actually your 24 hours. So this is the day. From this dotted line up to this dotted line is your 1 day. And during this 1 day, this is the price action, whatever is happening. During this 1 day, you got 24 bar, and in the 24 bar, some of the bar is actually reached up here. So that's your lowest of the day, and that's your highest of the day. This is the price, this is where the price actually open on that day, and this is where the price actually close. So based on this one, you can see that opening and the closing. So closing price is higher than the opening price. It means when you shift to the daily chart, the 1 bar will actually show you the green. This is the lowest of the day, and this is the highest of the day on that particular day. Now, this entire price action from right up to here is just represented in this 1 daily bar. So now you can see that sometimes people, they start losing money. The reason why they lose money in the shorter time frame, that's the volatility in the market is quite high. And if you don't understand this volatility, then you will start losing the money. But if you look at on the daily basis, the daily basis is actually quite clear, and you can see that this is a small bar, It's not a big bar. There is not much money in the market. And either you can, based on this one single bar, you can make your decision on the daily basis if the price is going down. It reaches here, yeah, maybe, but will it actually go any further down or not? So you can see you go to the lower time frame and it will be harder for you to understand what to do in the market because you don't have enough time to understand, and plus is quite erratic, going up and down all the time. But on the daily time frame or the 4 hour or the or bigger time frame, it's the price action is quite clear. This is again, this is a 5-minute chart, right? And you can see that the fluctuation is too noisy here. From here of all here, the 5-minute chart. So 5 minutes represent one bar, 1, 2, so 10 minutes, when like so likewise. And if you look at this chart, and if you look at this one, 1, 2, 3, 4, this is a 1 day. And this is the 1 day on the 5-minute chart. You can see which one is easy to trade. Here you can see that signal quite easily. Here it's just too noisy. Here probably somebody will say, oh shit, what's happened with the market? Now what I do? But here you don't see that. So if everybody knows that when the US president election happens, there was some the fluctuation in the market, which was very, very high. And if you want to see on the chart, you will be surprised that it's not that high at all. So for example, up here, right? When was the election? That's one. You see? This is the US election day. If you actually, this is on the same day, right? And if you actually open into the hourly chart, that time frame, which was, around here. It's the 2nd November, isn't it? Here you go. That's what's happened on hourly basis. Now you can compare this hourly basis from here. That's one, and there is only one single line, and you can see that people actually have made money from this way to up and then way down. So you can see that on the daily basis is a lot different. It's only one bar, big bar here. Okay, so on this particular chart, you can see that some of the candles, they have a different size, different type. Some have very, very long upper wick or high wick or low wick. So what I will do, I'll just go back a little one here. Right, so what we will do, this high wick, this upper wick we will call high wick. This one we will call it's a low wick. So that's a low wick, that's a high wick, and that's the body. Okay, now come back to here, this 5 minutes chart, right? You can see that some of those bars, their body is quite long. Their wicks are very small, like this one. And the sum of the bodies are very strong, very small, and the wicks are very low. So what we need to do, we need to actually understand those candlesticks which can reverse the market and which cannot reverse the market. So this is what we're actually trying to understand in the next few slides. And to start with that, I'll go from here. So for example, this particular candle pattern, you can see here that it's got very, very small, very small body, but very high wick. And this one. So this one is a red, this one is a green, right? Now you can see that when you see this candle price didn't move in the opposite direction, but when you see this one, the price actually moved in the opposite direction. So that's very important to understand that any particular pattern of the candle, its context, it's on the top of the range, or it's on the bottom of the range, or it's in the middle of the range. So that's, for example, is this one, and let me see if I can find, and one, yeah, I can't see anymore. And this one, like you can see this one and this one. So these, all the ones, they actually got the same characteristic. They got a high wick, very, very long compared with their body and the short. But their location, which actually determines what's going to happen with the price. So this is in the middle of the price, nothing happened. This is on the top, it's reversed the price. This is on the bottom, but it didn't reverse because the candle is actually, this candle represents, and it shows that's the, it can't actually move the price high. So this is the selling pressure. This is the selling pressure. Sorry, this is the selling pressure. But the difference is that here market is already in a selling mode. So it has no significance. Here market is in a buying mode, and then you suddenly see a lot of selling pressure. That's a significance. Here you can see that market is on the same seller pressure, and then market here is actually got more selling, so it's got no, the significance because market is already moving down. It's not actually on the top. So this bar compared with these three, it have a significance that market actually was in a bullish mode, and then you got, so like this is a selling, sorry, this is a buying all the way up, and then you start selling pressure, then you can see the reverse. Here you got a selling pressure, more selling pressure, so it's no significance, and the same thing here, right? So that's how you need to understand this one, and that's what we're going to do in the next few slides. Here again, you see this one. That's again, this is a selling pressure, a lots of buying pressure. Prices actually move, seller move down up here, then it's push it back up here. But the price didn't move much lower, and then you can see it starts selling. So it's mean that this particular bar, it has no significance on the price reversal at all. And why? It's because of its location or because of its color. Doji. When you see the prices, opening price and the close pricing are almost the same, it's no difference between the two, and you got a long shadow or long wick up or down, then it's called a doji. Now doji got so many different variations. You got long legs doji, you got dragonfly doji, you got gravestone doji, and you got four price doji. But the important thing is that your opening and closing price are almost the same. They don't change. You got a long wick at the top, you got a high long wick at the bottom, and that is a doji. Doji means that when the price, opening and closing price are almost the same position, then it means that market is in indecision. Market is confused. So it means that we don't do anything when we see the doji. We let the market decide which direction it wants to go, and then we actually enter into the market. Doji can actually give, it's a kind of a reversal signal, but again, it's based on its location. If it's on the top of the range, yes, it can reverse. If it's bottom of the range, then it can actually can't reverse. Now, how do you know that doji is actually reach its top? We don't know. The only way we can know, we can wait for the next bar. If the next bar closes below the doji or below the doji, then it means that market is in the reverse direction. Only at that time we enter into the market. Otherwise, just based on the doji, we do not enter into the market because maybe the next bar is actually close higher of the doji, and then this doji have no significance because it's in between of the price range. So doji itself is not a trading entry point. Doji itself is just a signal that market may reverse, but we have to wait for the market to reverse for at least one bar, and then we enter into the market. One of the things is about the doji, when the opening and closing price are almost the same, it means that the market have no momentum. If something have no momentum, then you can't make money, so you have to wait. here is an example. So this is, you've got a high bars, yes, buying, buy long, and then suddenly you see the doji. Now, if you don't have this part up here, is a hidden this part, then you don't know that it's a doji, either valid or not. But you wait for this bar, and then you see, yes, it was a confirmed doji, because this doji is higher than this, and it's higher than this. Now you enter into your market around here or around here, and then you go all the way right up to here. So you actually short your market here, and you actually exit wherever you can see the other signal, and that's your profit. So don't make your decision only based on the doji. Doji is just one part of your technique, or one part of your understanding how market can reverse. Right. I think this exercise many people actually have done before. And here I can show you a few of the doji and see why it's not important. So first of all, you can see this is the doji, this doji, this doji, this is the doji, this is the doji, 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 and doji. All you need to do, you need to first, your first step of chart recognition skill, you try to understand this different kind of the bar. So when you put your eye on a chart, within 10 or 15 seconds, you should know where those different type of the bar and what's happening. So if I see on this chart, I can see this, all those dojis, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, and whatever. And now I can see, yes, I can see those are so many dojis. And then after that, I will actually make my decision based on what I want to do. So this is another one. So here is a doji. Here is a doji, 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 doji. So this is just for the practice. And if you, maybe what I can do, I can actually go to the live trading, live chart, and see if you can see something there. Right. So we got this Euro USD on hourly chart, and we try to find some dojis and see what they have done. Right. So here is go. We got a doji here, right? But the problem with this doji is that it is actually at the bottom of the pricing here. You can see this is the bottom of the pricing, and this doji is lower. It's actually almost the same position as this one. So will this doji will see any price reversal? Yes or no? Here you go, right up. This one, yeah, that's one, right? But would you buy on this doji? No, because you're looking for the price reversal, you're looking towards down, because you can see on this doji, that's doji actually showing that the seller pressure is increasing. So you expecting to price to reverse towards the bottom, right? But in fact, the price is going higher. So that's why this particular doji was have no significance. And if I would have to, let's say, I can see here, now I wait for the next bar. I'm waiting for the next bar. And then I can see, oh, sorry, this is not the reversal doji, so I won't trade that one. That's easy. Let's put it, that one here, up here. So, okay, so this is the another bar. And then I can see a doji. When I see this doji, I can see this is actually higher than the last 2-3 bars. And now I'm a little bit excited. That's maybe I can enter into the trade. But I can't enter into the trade right now. I have to wait for the pricings to move down. So I will wait for one more bar. So I just move right up here, right? The next bar I can see, yes, it is, price is actually moving down, but I'm still not confirmed because this is also the lower bar. So what I will do, I will make my entry up here. That's my entry. Okay, so that will be my entry. I would enter into the market here, and I will see if the price is actually really moving down, then it will touch my prices and it's continue to go down. Otherwise, if it's going to go up, then I will not have any impact at all. So let's move the 1 bar more, and now you can see. So I entered in the price here and all the way back up here. So I actually made on this particular trade from here all the way up to here, 14 pips in how many hours? 1, 2, 3 hours. Here you go, it's going further. Right? But because when I see this signal, I was actually a little bit suspicious that's whether I should go, I can wait or not. What normally I do, when I see this particular price pattern, which is this doji, and this 2 to the left and this 2 to the right, like this are the low, and this is high, and this is low, and it means that it's the perfect swing high position, and the price is moving. I will enter here, and then I normally enter about 4 or 5 lots here, based on your, again, the number of the lots is always based on your account size. So if I enter about 3 lots here, I will sell 1 lot here, 1 lot here, and I will leave the 1 lot continue as far as it can go. Okay, so it is the same thing here. You can see this is the doji. So, and normally you enter the price up here. I don't know, I can use my pen. So you enter the price, that's your entry price. And then the reason why I put this entry price, because I know that this is the doji, because it's confirmed by this one, but I still want further confirmation. So I wait for the lowest of this bar. And if the price is moving direct or further down, then I will actually move up here. Okay, I'm actually at the moment, there are multiple ways to do it. So someone is asking how to interpret move without the doji, the one with the big red move after the green. Okay, so we actually at the moment only covering the doji. When the time will come, we will cover other as well. Okay, so let's find another one, another doji somewhere around here and see how we trade that one. This one. It's not actually a doji, but it's a long wick up here, and it's higher than this too, and it's higher than this too. So this, will you trade here? Because this is a very big bar here. The price is already moved. If you would actually wait for the next bar, then this price, you actually lose this trading opportunity. You don't have to enter the trade because you can't enter the trade here, because the rule says we will see the next bar and after this enter the trade. If it's already very long move, then that's it. We're not going to trade that. And you can see it didn't move a lot and it's gone back up. Another one is hammer. Hammer is a small real body. So you can see this is the hammer. It's got a long low wick and it's got a higher, it's got a very small upper body. So its opening and closing price is like small, and the wick is at least 3 times of this body. So if, and that's actually represented, it doesn't matter the color. When you see hammer, it's normally at the bottom of the price. It's been near the supporting area of the price. If you see the hammer here, it's a very strong reversal pattern. And we will actually see in next candle. But again, we always confirm for the candle, next candle. So here, you can see this hammer and then the prices goes up. And the hangman and hammer is almost the same. It's their location. So hammer is normally at the bottom of the price and hangman at the top of the price. Now, why we say this hangman is a reversal pattern for the towards down, even though that the price is actually moving upward, because if this is open, or sorry, this is open, this is closed, and there's a long shadow, lower shadow, it means that the price is actually trying to move towards here, the sell, but the seller was not successful and price actually move higher. So that's, even though that's, if it's a green color, then you won't see this is a hammer is going to reverse the price, because your opening price is here and the closing price here. So that's a difference you need to understand. If you see hangman or hammer at the top of the price, it doesn't have that much significance, but if the hammer happening at the bottom of the price, as here, it's have a very big significance on the price reversal towards the norm. And let's see if we can find some in the chart, right? So, for example, hammer. Right here, this is the hammer. So you can see that if I have to enter in my price, then I'll have a 2 times to enter. So I can see this hammer, I wait for this bar. So either I will enter here, or if because hammer is a strong price, I will enter somewhere here. Okay. And when I enter, it's a long position, and then you can see the price move all the way up to here. And if you want to see how many pips you would have made, even if you go conservatively and you enter on here, it's right up to 31 pips in about how many? 27 hours. So 27 hours means it's 1 day. In 1 day is the 31 pips. If you got one lot, 31 pips times 10, it's $320. Right. Let's try to find some hammer in this chart. Okay, I'm going to point 1, 2, 3, 1, 2, 3, 3 hammers. Again, another hammer right up here. You can see the price actually move up. Shooting star. So shooting star is just if you invert the hammer, then it's become a shooting star. So in the hammer, you got a low wick. In the shooting star, you have a high wick. Now that shooting star can happen at the top of the range, and it can also happen at the bottom of the range. So again, the significance is the important part where it's happening. And this is how we actually try to interpret. So you can see this one here, the price is going up, and then you see the shooting star. Now what the shooting star actually will tell you, will it reverse the price or will it not reverse the price? Now you need to understand the basic principle of interpreting the candle. That's if higher the wick at the upper side or bigger the wick at the upper side, it means that the buyer will try to push the prices at that level, but seller were successful and they bring the price down. It means the longer high wick is always a selling pressure. Selling pressure means that prices will move down. If you got a long lower wick, it means that there is a buying pressure, and buying pressure means that the prices will go up. So based on this analogy, you can see the shooting star is always reverse the price towards the selling point. But it's all depend on where the location, what is the location of the shooting star is. Here you go. That's one of the shooting star. As you can see, gone down. What does it mean? The shooting star will always appear on the top of the range, top of the price range, near the resistance level. So if you got now you see in the very few early slides, we said like we need to increase our probabilities. So this is how you increase your probabilities. That's you got your the resistance somewhere around here, then you suddenly see the shooting star, and you also see that the price is that the last 1 or 2 bar was lower. It means that the momentum is losing and the market may reverse. So you can see that's how you increase the probabilities, and this is how then your price is coming down. Okay, so here we're going to find some shooting stars. Again, just for a practice. So this is one. I can see only one. Yep, I don't see anyone. So I can see only this one. Here you go, another way to find the shooting star. See, this is the one, the shooting star. There is another shooting star here, but I think this is actually in the middle of the price. So that's why it have no significance. So all those, the reversal candles, which we are talking, for example, doji, hammer, and shooting star, they have one very, very common principle. The middle candle will always have two candles to the left and two candles to the right, which they both will go lower or higher depending on which way you're looking. If you're looking, for example, this shooting star, so two to the left, they are lower, and two to the right, they are lower. So many people who are more conservative traders, they actually wait for this the entire formation to complete, 5 candle formation, which is called swing high. If you wait for the swing high, it means your entry will be somewhere around here, from here all the way back here. So some aggressive one, they will just wait for this candle and they enter the low of that candle, and that's it. Someone who actually have no patience, they will basically see this one, they will enter into the market, and then this is what's happened with them. So they entered the wrong side. So you need to actually understand that's when you're going to enter, when you're going to use this candle and enter into the market. So make sure it's a perfect swing high, two to the left, two to the right, and yes, now it will go down. So that's why it's got more significance, and you will make some money from that. Okay, this is a morning star. It's got no significance, so don't worry about this one at this stage. We will learn later. Now, what we're going to do for pivot high and pivot low. How much time we got? We got half an hour. All right. We will cover this pivot high, pivot low, and then we will go for the lunch and then come back, and then we do some other things. Okay. Remember, I was talking to you about this two to the left and two to the right, and perfect swing high and swing low point. So this is what's happened. This 5 candle formation, where you see that the middle candle is going like it's up, then the 2 left, and then 2 to the right. So that's actually called the swing point, and that's when you see this swing high point, it's actually very, very significant in the price reversal. With this swing high, you see this the middle candle is a kind of a setup candle, pin bar or doji or the shooting star, or then it's more confirmation. So we only learned so far the doji and the shooting star. So if the middle candle is a doji or the shooting star, that's actually a strong confirmation that the prices will reverse towards down. And this is opposite for the buy long. So you got the prices coming down. Now this one is a hammer, then the prices move back. So you wait for finishing of these 4 candles. On the 5th candle, you enter into the market, and then you go all the way. Okay, here we try to identify some pivot high and pivot low, pivot points. So let's start from here. So 2 to the left, 2 to the right, that's the pivot high. And that's a perfect swing high point. And you can see this swing high, it's got this reversal candle where you got the small body and the long upper wick, and the prices moved right back up here. So swing high combined with the doji or your shooting star, that's your one of the very, very key signal for the price reversal. Now, so this is the one. Let's look at another one. So this one is actually a reversal signal, but it's very low, so we don't consider this one. And you might have missed out on all those. This is another one. Here is another one. 2 to the left, 2 to the right, right? And then you can enter into the market here somewhere, and then you go right up to here. So now did you notice this bar, this setup bar, and this setup bar? A difference here is that this particular hammer or the doji downside, it's got very, very small bodies in two to the left, right? And that signifies that the momentum towards down or momentum, whatever in the market, is actually reducing. And that's why the from point to different here, you don't see much thing. Okay, right. So we were talking about this swing point, swing high, and the swing low, and the difference between the two, why the one actually caused a big price movement and one didn't cause a big price movement. And this is the reason why, is because before the swing, the previous 2 bars or 3 bars, they were not very strong compared with this one. All those sort of things you need to understand to gauge your exit and entry. This is another one, 2 to the left, 2 to the right, and there's a swing point, and you can see that this formation of these 2 candles before that, compare with that, and compare with that. So you can see when you got a setup bar, you also need to understand that's what's happened in the previous previous move, and then you go right up to here. Okay, what else we got? The swing point. This is another kind of a swing point, but it's not very strong. And again, this price is not stand out above those previous one because it's at the wrong side of the. If you have seen this particular bar in somewhere around here in the support area, then the prices goes up. That's the reversal pattern for the bullish, not the bearish. So that's why it has no significance. Now, to understand this swing high and swing low, how the trend actually form, what you need to do, you need to see the price always move in a cycle. If the price is to move always in one direction, then there would have been no opportunities in the market. Nobody would buy anything and nobody would be able to sell anything. So the price always goes into the cycle. They will go up, they will go down, they will go sideways. And you need to understand that you are in which cycle of the market. If you are on the down cycle of the market, and if you go long, then of course you will lose money. If you are on the upside of the market and you are on the right cycle and you buy, then yes, you will make some money. So for example, let's say the price was at this level, it's moved up, then we call this one high, right? The high of the point. Then the price is actually moved down. We call it higher low. Why we call it higher low? Higher low. So HL, higher low, higher low. And then we got another prices move up next cycle. And that's what we call higher high. Why we call this one higher high? This high is higher than this high. And that's why we call higher high, higher low. The reason why this high and low is because this low is actually higher than this low, or you can call it this is high, low, because this is the first side and this is the second. Now the price has moved down, and again we got a high low. Now you need to see that this low is higher than this low. This high is higher than this high. So this is the price is actually moving upward direction. Higher high, higher low. This cycle, when you see this kind of cycle, we call this is an uptrend. The reason why we call it uptrend, because you can see your price is actually moving this direction. Wherever is actually touching that's high and low, that's become your support line. And that support when the price actually goes here and then bounce back, bounce back. Now you can see your price is still going high, higher high. So what's happened here, that's this particular thing is called 1 cycle, 2 cycle, 3 cycle, and then 4 cycle. Now, when you see that, your prices on the next cycle, whenever it's actually moved down to the previous higher low, this is a signal that you should be actually cautious that prices may start turning down. The cycle is changing. And then you can see that it's a low, low, lower low, lower high. Lower high means that this low is this low is lower than this high. Lower high. So this is lower than this high. This is lower than this, lower than this. This high is lower than this. This one is lower than this. So that's lower high. And that's actually become your next cycle. So you can see on this thing, this one, that's your price is moving up, then your price is actually moving down. It's actually here, down, right? And the point where actually the next lower point is actually lower than this one, it means that the price cycle is actually changing. Now, this is the thing which we just talked, is in a little bit more format, proper Google image cut and paste. So you can see that it's a lower low, lower low, lower low, lower than this high, lower than this high, lower than this high, and that's your downtrend. Higher high, higher high, higher high, higher low. This lower than this is this low is higher than this. This low is higher than this. This low is higher than this. So that's actually upward trend. Now, in every single market, or whether you're trading stock, you're trading Forex, you're trading future, or whatever, whenever there is a chart, in the chart, you will always see prices moving in this direction. They don't go any other direction. They will go up, they will go down, or they will go sideways. So to understand that the trend is up or down, you need to understand the swing points. The swing point will actually tell you it's a lower high or is a higher high. If you don't understand the swing point, you won't be able to draw the trend on your chart. And if you can't draw the trend on your chart, then swing, you don't understand the market. So it's very important. These 3 points to understand the market trend is: number one, your swing points. Number two, your lower low, lower high. It means high of the point and the low of the point. And also like it's on the sideway or it's moving which direction. So make sure you understand the swing point, swing high, swing low, lower high, lower low, and higher high and higher low. Okay, in this particular video, we are actually going to see, sorry, this is not video, this is a slide. So this is the low point. This is the high. This is the low. This low is higher than this. Then it goes up, and this low is higher than this. Then it goes up, then it goes down. And this one is actually lower than this one. So it's means your trend is changing here. And you can draw this line and you can see quite easily. So for example, let's say this one, and then you can see this one.
We need a screwdriver for my new toy.
Okay. So this, we will end up here and we go for our break, for 1 hour break. It's 12:40 now. So maybe we come back at 1:40. Any questions before we go?
Can we have a recording for this all slots, because I can't hear some of the words, so I can hear it again.
Let me just check if I'm recording or not. Yes, I am. Okay, so I'm actually,
because